Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And I was browsing through some news articles, and I noticed that there's a lot of articles now about how Gen Z is struggling with credit card debt. So you can see from the Wall Street Journal right here, it says Gen Z sinks deeper into debt. And then if we scroll down, right, CNN says 1 in 7 Gen Z credit card users are, quote, maxed out. Gen Z credit scores on the rise along with debt balances. So this is really interesting. It's like, the credit bureaus know the more debt you have, the more your credit score rises, right? And then if we scroll all the way down, videos, Gen Z struggling with credit card debt, Gen Z and credit card debt, huge problems. Gen Z weighed down by credit card debt, according to a new study. According to the New York State Society of CPAs, Gen Z has the largest percentage of credit card debt. And it's on and on and on. Now, I'm going to take a look at this. This is really interesting, right? So, when you see those doom and gloom headlines, you're like, oh man, they must be really into it, right? And then it says on average, they have about $2,834 in credit card debt. $2,834. And that makes me laugh because I've done so many of these velocity banking situations where it's like, oh, you have $40,000 in credit card debt or $176,000 in credit card debt. And we paid it off no easy. And so when I see $2,834, that makes me laugh. And I'm just like rolling my eyes. This is such an easy situation to resolve with velocity banking. And here we have the average interest rate is 21.5%. Okay, we'll just do 30%. No, not a problem. But again, what's really funny is that, you know, this isn't really that much debt, but at the same time, it could probably be wiped out just by doing velocity banking, and they're the least likely to watch this type of content. So if I take a look at my YouTube analytics right here for the YouTube channel, you'll notice that ages 13 to 17, absolutely nobody has watched this channel in the last 28 days. And then 18 to 24, absolutely nobody has watched this channel for the last 28 days. And then 25 to 34, only 4.7% of people have watched this channel. And then and then you could see that the vast majority of people who watch this channel are 35 and older. Isn't that interesting? So the people who are, quote, struggling are the least likely to watch this channel, and it's all relative, right? So when I see like, oh, $2,834 of credit card debt, how are you struggling? It's kind of a mystery, right? But I remember probably when I was that age that if somebody gave me a $5,000 credit card, I would be like, "That's so much money." And then now, if somebody gives me a $5,000 credit card, I'm like, I'm insulted, right? So it's all relative. So again, if you're 13 to 17, I understand if you're not watching this channel, you probably play Fortnite or something. But 18 to 24, that's when you got to get a little bit more serious with your life. Same thing with 25 to 34. That's kind of like prime working years, right? You're just starting your life and hopefully want to get a house and all that. And then afterwards, I think what happens is that people realize they've been paying into the system and really not getting that much out of it. And that's why they're so interested in velocity banking because they have the life experience to understand, hey, the strategy where you put all of your money into the line of credit is really valuable, right? And so we're going to struggle. I'm not struggle. We're going to simulate this so-called struggle for Gen Z using velocity banking. And I'm kind of making fun, but that it's not because I'm necessarily picking on them. It's just more like we've done so many of these velocity banking scenarios where we're paying off 50, 100, $200,000 of debt, no problem. And when I say $2,834, I'm laughing, right? So let's go ahead and do velocity banking, a velocity banking spreadsheet demo. So what is velocity banking? All it is a debt payoff strategy using a line of credit as your main tool. And what is a line of credit? All it is a financial tool where you could borrow money, pay back, and use it over and over again. So if you heard of a credit card, that's essentially a line of credit. And there's only two requirements to do velocity banking. Number one is a budget. So I have this budget right here: income, expenses, leftover savings. And then here we have our expenses. We just got to separate the debt versus the non-debt. So we'll just assume we have a credit card, one credit card of $2,834, right? And then we have other things like food, gas, insurance, 1,500. Okay. Now, we're also going to assume that this person doesn't pay rent because the average rent in this country is about $2,000 a month. And if you're only making about $40,000 gross, I don't think anybody's going to rent to you. Like, I'm going to be honest, like, because of inflation, because housing has gone up so much, and because landlords don't want to rent to people who don't make three times the income, and I, as a landlord myself, can attest to this. I'll just assume that they live at home. So it's just gonna be really easy. Um, one credit card, and then all the other good stuff that you might need to spend with a $40,000 salary. And if you don't know where, you want to know how much the net, or I'm sorry, the after tax income is, you could just go to a website like smartasset.com and then put in the salary and then show you your semi monthly take home pay, and then you just multiply it by two. So it's 1348, right? So I think I have it right here, 1348 times two. All right, so now what we're gonna do is use our line of credit as our main operating account. So again, we're struggling with this $2,834 of credit card debt, supposedly. But and actually, let me just do this before I do the velocity banking strategy with this scenario. I just find it funny that we've been doing scenarios with $167,000 of credit card debt, and we didn't sweat it. But supposedly Gen Z is struggling with this itty bitty $2,834, right? Now, we assume two things. Number one is that we have the same income, okay? $2,696. Number two, again, this is the opposite of what most personal finance will teach you, especially Dave Ramsey. We're not saving any money because all of our income is going to go to the line of credit, right? So the actual strategy is that we're gonna make our line of credit, aka our credit card in this case, as our main operating account, right? So we have a $3,000 limit available, and we have a balance of 2,834, and let's just call this month zero. And so what we're going to do is dump all of our money into that credit card. Okay, dump all of our money and then take our expenses out, and we have zero savings, but we're going to have something called cash flow, which is very similar to savings. Okay, and just by making this our main operating account, because we're going to dump the entire $2,696 here, we're going to set this to zero, right? And what's really interesting is because the way that credit card interest works, I think if we dump all of our money into this line of credit, okay, dump all of our money, we probably could get rid of the credit card interest in like 1 month, because the credit card interest is calculated mostly is pretty much on the statement balance, and so if you're able to pay into that statement balance, you're not getting, they're not charging you interest anymore. Really interesting, right? So in this case, it might even be more advantageous to use a credit card than even a regular personal or home equity line of credit. I don't know. I Every credit card issue is different, but that's what I think. If you have a credit card balance that essentially is the exact same, or statement balance that's exactly the same as the income, right? So what do you think about? All right. So the actual strategy itself is paycheck into line of credit, right? Expenses out, which this is 1,500, and then your balance goes down by $1,196. Okay, so let's go and show our fellow Generation Zers. How do you do, kids? Actually, I don't know if that makes me sound weird, but okay. So how to do velocity banking? So let's go ahead, and we have month zero here. So we just calculate the first month. All right. And then what we do is we put our entire paycheck into this line of credit, this entire $2,696, and then we take our expenses out. And so after every single month, it's going to go down $1,196. So previous month's balance plus previous month's interest minus our cash flow, which is 1196. Okay. And then the interest is traditionally, or with a personal or home equity line of credit, is calculated by the average daily balance. In the case of a credit card, it's going to be based on like the average daily balance at the time of the statement, I think, right? So we're going to multiply it by, we'll say 30%, even though like the news article is saying that the average interest rate was 21.5. But let's do 30%. Let's go all in, right? So 30% is nothing to fear. And then you divide by 12 to get the monthly interest rate. Okay. And then what you do is just copy and paste these formulas, and voila. In 3 months, we paid off all this 2,900 and whatever dollars of credit card debt. So, oh my goodness, it's a crisis that they have so much credit card. I don't know if this is a joke or not. I'm like literally serious. Like, is this some kind of a joke? But I guess it's all relative too, because $2,834 seems like a lot, but um, I can't fault them if they think it's a lot, but they probably would really benefit from the strategy of dumping your entire income into that credit card to get rid of it. Because if number one, bank's never going to lend you money unless you have some income, and you put your entire paycheck into your line of credit, expenses out. Entire paycheck in line of credit, expenses out. And whether you make $2,696 or $9,644, your debt is going to be proportional to your income. Every lender does that. They're going to check how much debt you have, and then they'll lend you based on if you think you can handle more debt, right? So whether you're making this itty bitty money, or it seems itty bitty to me, or this amount, it's the same thing. Income in, expenses out. All right. All right. Well, that's it for today. So hopefully you could pass this on to the demographic that least watches this channel. They're the least likely to watch this channel, but supposedly they're the ones most likely to struggle with the credit card debt. Very interesting, right? The ones least likely to watch this stuff are the ones most likely to struggle with the things that we say, hey, we're not gonna struggle with credit card debt anymore. All right. Well, that's it for today. Have a great day, and we'll speak next time.